Donating stocks instead of cash can often be a much better option for both parties. A wide range of charities, schools, hospitals and other non-profit organisations prefer receiving stocks as a gift or donation as it provides them with tax benefits and maximises their gains. These organisations appreciate all kinds of donations, but from a donor's perspective, cash donations aren't the most financially viable option. Several veteran investors already understand that stock donations are a better way to maximise their charitable giving and offer tax benefits to both parties, and new investors are quickly catching on. So in this video, I'll run you through what the benefits of doing so are. But just quickly subscribe to the channel and press the bell icon to stay across the latest videos from Kalki. Tax benefits of stock donations. The owner of a stock doesn't need to pay any capital gains tax in case of an increase in the value of the stock from the time of its purchase. The stock can instead be donated to another party to avoid the tax altogether. If the securities are being donated to a charitable organisation, the total amount of donation will be eligible for a tax deduction, and thus the donor will be incentivised to make a bigger donation. This benefits both parties, as the avoidance of tax by donors leads to higher donations for charitable organisations. Another notable point to consider is that if the stock is held for less than a year, then your deduction would be limited to cost basis. While in the case of holding stocks for more than a year, the full fair market value of the donated stock may be deducted before giving it away. Also, it's generally better to sell a stock prior to donating cash to a charity if the stock is trading at a price less than what you purchased it for. This enables you to take the loss, which can be used for tax purposes. Is donating a stock a good option? Seasoned investors and entrepreneurs get enormous tax benefits by donating stocks. Donating securities is becoming a very popular investment move for wealthy donors. While increasing private wealth accumulation is creating inequalities in society, incentivised charitable giving is genuinely creating a significant difference. Investors can use stock donations to integrate their investment strategy using tax-effective tactics. Wealthier investors use stock donations to optimise their portfolio, which has the added effect of benefiting a number of worthy causes in the community. So the bottom line is that stock donations are carried out online, they're safe, secure, and can procure an even bigger advantage for charities than a standard cash donation. The tax breaks are of course also highly beneficial for donors. So if you're thinking of giving as we approach the festive season, how about thinking of doing so from your portfolio and not from your wallet? If you enjoyed the information contained in this video, then please make sure to like, share, comment and subscribe to the channel, and of course don't forget to press the bell icon to stay across the latest videos from Kalki. For more information, just head across to the website kalkinemedia.com. I'm James Preston, reporting for Kalki.